Now that we understand the methodology, I'll take you through a practical example to see how the PUCM method is applied and then guide you through the important aspects of reporting and the common questions often auditors ask. So let's look at the numbers. This slide primarily outlines the inputs and assumptions for a single employee. So under benefit structure, we have details like yearly leave accrual, maximum accumulation, and that leave encashment is based on last run basic salary, while availment is based on last run CTC salary. We are also using a LIFO basis for future availment and a normal retirement age of 65 years. Our key inputs include valuation date, that is 31st March 2025, employee's current age, which is 55, monthly basic salary given as 30,000, and CTC given as 60,000. Also, the closing leave balance stands at 50 days. With respect to assumptions, we are assuming a salary growth rate of 8% per annum, discount rate of 7% per annum, and a leave availment rate of 2% per annum. Lastly, for simplicity, this scenario assumes no mortality and no attrition, focusing solely on the leave projection. So now we'll show the application of PUCM using the inputs as shown below. While it looks like a lot of numbers, let me break down the core idea. So here we can see that for each year, we are projecting the employee's age, his projected leave balances, and the expected leaves availed. We are also projecting the basic and CTC salaries. And most importantly, the total expected benefit payable, both on account of encashment at retirement and on account of availment during service. So you can see how the projected basic salary increases year on year due to the salary escalation rate here. First, let's talk about accrued or discontinuance liability. So this is nothing, it's a simple mathematical calculation based on the employee's current leave balance and current basic salary. The amount of 50,000 here represents the leave benefit that would be due if the employee leaves today. However, actuarial valuation looks into the future. It projects two types of expected payouts. One is the total expected benefit payable on account of encashment at retirement, which is coming at 88,200. This is the total cash we expect to pay this employee for his accumulated unused leave when he eventually retires. Second is the total expected benefit payable during service on account of availment, which is coming out to be 28,257. This is the total estimated cost for leaves the employee is expected to take but not cash out during his working years. Now, because these payments are in the future, we need to bring them back to the current value using a process called discounting. So here, as we can see, 88,000 for future encashment when discounted has a present value of 44,836 today using a discount rate of 7%. Similarly, 28,257 for future availment when discounted has a present value of 19,230 today. And finally, the actuarial liability of 64,066 is the sum of these two discounted values. This is the precise amount that your company must recognize on its balance sheet today. It represents the best estimate of your current financial commitment for this employee's future leave benefits, taking into account all the projections and the time value of money. Now, moving on, let's discuss why the choice and application of actuarial methodology, particularly PUCM in this case, are so critical, especially when it comes to audit scrutiny and the company's P&L account. The methodology isn't just a technical exercise, it has significant implications on the financials as well as the stakeholders' confidence. Starting with compliance. So, firstly, PUCM is a regulatory requirement under accounting standards like AS 15 and NDS 19 for long term employee benefits. It mandates the calculation of the present value of obligation and the current service cost, which is the cost of benefits earned by employees during the current period. So, adhering to this ensures that your financial statements are compliant. Second is accuracy. PUCM spreads the cost over the employee's service period. So, this enables stable and consistent expense recognition, avoiding large volatile swings. It directly aligns with the matching principle in accounting, where expenses are recognized in the same period as the revenue they help generate. So, in this case, the period in which the employee actually earns the benefit. Next is transparency. The methodology involves projecting future payouts using robust financial and demographic assumptions. This detailed approach helps auditors evaluate the reasonableness and consistency of your provisions. It ensures that realistic costs for employee benefits are reflected accurately in the P&L, providing a clear picture to the stakeholders. Okay, coming to consistency, PUCM is not just for leave benefits. It's also applied for valuing other long-term benefits such as gratuity, pensions, and long service awards. So this uniformity across different benefit schemes ensures consistency in actuarial methods, making year-on-year comparability of expenses much easier and more reliable. And last is impact on financials. The application of a standardized methodology like PUCM significantly boosts the audit reliability and stakeholder trust. When leave provisions are accurately calculated and reported, it avoids material misstatements. So, incorrect or underestimated leave provisions can directly impact the operating expenses, and it also influences the EBITDA, which paints a misleading picture of profitability. So, accurate valuation helps prevent these issues by aligning recognition and disclosure with accounting standards, ensuring a true and fair view of the company's financial health. Okay, so moving forward, our next section talks about the reporting and disclosure requirements. But before diving into the reporting requirements, it's important to understand that the output of an actuarial valuation extends beyond just a single liability figure. A comprehensive actuarial report provides several valuable insights, starting with the report itself. So, this is a detailed document that includes a review of input data, outlines key assumptions, describes the benefit structures, and validates the liability figures against expectations. It helps ensure the numbers make sense in the context of your business. Coming to employee-wise liabilities. So, for many companies, obtaining employee-wise liability figures can be immensely beneficial. It enhances confidence in the valuation results It helps to track the workforce movements, and it can even assess the financial impact of employee transfers between different departments or entities. Third one is the actuarial liability to accrued liability reconciliation. This provides a simple yet effective check on the actuarially valued liability against internally accrued figures. It helps in tracing year-on-year consistency and accuracy in valuations, highlighting any discrepancies. And last includes experience variance, sensitivity analysis, and any additional information. So first, experience variance allows you to study the efficiency of the assumptions made at the beginning. That is, whether the actual experience, like actual attrition rate or salary increment, matches with what was assumed. Second, sensitivity analysis again is crucial for understanding risk. It analyzes the impact of a change in key assumptions like a 1% change in discount rate or salary growth rate on the liability. This gives management and auditors a clear picture of the volatility and robustness of the valuation. Additional information such as average age, average past service, and expected remaining working life further enriches the report. Now, moving on. So, when preparing your actuarial report, several key considerations must be addressed to ensure that it's comprehensive and it meets the audit requirements. As per paragraph 154 of Ind AS 19, which states that the measurement of other long-term employee benefits is not usually subject to the same degree of uncertainty as the measurement of post-employment benefits. So for this particular reason, this standard requires a simplified method of accounting for other long-term employee benefits. Unlike the accounting required for post-employment benefits, this method does not recognize remeasurements in other comprehensive income. This means that the total actuarial gains and losses typically goes through P&L for these benefits. Now, here's what a good report includes. First, being purpose of the report, which clearly states that why the valuation is conducted, then overview of the data used, then the benefit structure, which again provides a detailed description of the leave policy as we have already discussed, valuation methodology, giving a clear explanation of the PUCM method applied, key data inputs like summaries of the raw data used, such as number of employees, total salary, average age, etc. Key assumptions used, a transparent presentation of all financial and demographic assumptions, coming down to profit and loss and financial position impact. So showing how the actuarial liability affects your income statement and balance sheet. And lastly, disclosure on appropriateness of assumptions. So regulators and auditors expect companies to justify their assumptions. And any significant changes from prior periods should be disclosed as they can materially impact valuation and expense recognition. Moving on to the disclosures. So as per APS 27, key disclosures include presenting vital data inputs like employee numbers and salaries, average past service, average age, total number of outstanding leaves received, etc., often with comparative figures. Additionally, a clear statement of the projected unit credit method used for valuation as per accounting standards is mandatory. Then, this slide covers the required disclosures for key actuarial assumptions. This includes financial assumptions such as the discount rate and the salary growth rate, and demographic assumptions like mortality, retirement age, attrition, and leave utilization rates, all presented with comparative figures for transparency. Lastly, a detailed benefit structure description is a key disclosure. This outlines the specific policy features influencing the valuation, such as accrual, accumulation, encashment rules, and benefit formulas on exit, providing clarity on the plan's design. Now, beyond specific data points, disclosures also detail the direct impact on your financial statements. This includes the balance sheet position, which shows the present value of obligation, the bifurcation of present value of obligation into current and non-current liabilities, and the expenses under the income statements, which outlines how the benefit costs are recognized. Now, let's move on to some common questions that the auditors might ask. So, first question, here are some of the most common audit queries we encounter when dealing with leave valuations. The first question is, what is the reason for conducting a leave valuation? The answer, again, as we have discussed, lies in compliance with accounting standards for long-term accumulating benefits and the need for correct financial representation. Second question, which methodology is more appropriate for valuation, FIFO or LIFO? Again, this depends on the company's specific policy and the historical leave utilization patterns. We covered the implications of each. Third question, how should the availment rate be determined? Typically, it's based on historical data and projected future utilization patterns, which gets adjusted for any known changes in the policy or employee behavior. Next is, what is the relevance of CTC salary in the valuation process? So again, CTC is relevant for valuing leave that is availed during employment, as it represents the full cost to the company for that employee's absence. Basic salary is usually used for encashment purposes. Moving on to the next question. For valuation purposes, should the Shops and Establishments Act be followed or should company policy prevail? This is a very common question. So generally the company's internal policy governs the actual benefit provided, but it must of course be compliant with minimum statutory requirements like the Shops and Establishments Act. The valuation reflects what the company is obligated to pay or provide as per its policy within the legal frame. Okay, moving on to the next question. Should freezed or non-accumulating leaves be included in the valuation? Freezed leaves, yes, if they represent a future liability, it typically it should be included. But non-accumulating leaves like casual leave that lapses, these are generally not included, as Punit explained earlier, as they don't create a long-term obligation. And last is, under what circumstances is sick leave valuation considered necessary? So if sick leave accumulates over time and is expected to be utilized even if not encashable, it creates a future obligation that requires valuation under long term employee benefit standards.